Hello, welcome to Better System Trader Live, the show for systematic and algorithmic traders. Glad you could join us today, where we're going to be talking about why trading can be so difficult and what to do about it. So let's get started. Well, good morning, good afternoon, good evening. Glad you could join us today. We're going to be talking about trading, well, obviously, but why trading can be so challenging, and what we can do about it. And today we've got a very special guest who has been on the show before in the old podcast audio days, and it's great to have him back. Yeah. So, welcome, Adam Grimes. Thanks for joining us today.
Happy to be with you. Good morning.
So, Adam, you've had, let me see my notes here. You've got over 2 decades of experience in the industry as a trader, an analyst, and a system developer.
Yes.
What I find fascinating about you is you've got a mix of discretionary and systematic approaches. So I think that we'll probably talk a little bit about that more today. But also, you're the founder of Market Life. Is there anything I missed? Do you want to give us a quick little bit of an intro on yourself?
I think that kind of covers it. I started trading. I've been all over the map. I started trading as a small individual trader. I like to say that I don't think anybody could start knowing less than I did. I had no previous knowledge or exposure to financial markets, and my initial experiences with the market were very consistent, but of course, losing. And eventually I figured it out. Over the years, I've done everything from very short-term scalping, day trading, to much longer-term fundamental, technical. Most of my focus now is on technical. And I've also done a good blend of discretionary and systematic approaches. So I've certainly wouldn't say that I've seen everything, but I've seen a lot of the different manifestations of the business and have made enough mistakes in enough places that maybe have a little bit of wisdom somewhere in there.
Well, that's excellent, because today we're going to talk about why trading can be so challenging. And I think someone with such a wide degree of experience as yourself has a lot to add to that. So why don't we just get straight into it?
Sure.
Why is it so hard to learn from the markets?
Well, it's funny because everybody talks about like these magical revelations they have. People claim to have found patterns in scripture or whatever, patterns and numbers and all of this secret stuff. I think my great revelation was that, gosh, this is really hard. And I discovered this myself as, I switched assets at several points in my career, and moving from my first success was with currencies, and then moving to stock index futures, and moving to trading commodities and to stocks and to options. And each time I would trade a new market, there was a lot that I knew, but it was amazing to me how much of a reset it was. And then I also have had the experience over the years of teaching and training in different capacities hundreds and hundreds of traders, and many of whom are very intelligent, very successful people in their own fields. And when they come to trading, that success does not immediately translate to trading success. So the puzzle that I started to spend a lot of time thinking about is, why is this so difficult? Why is it so difficult to learn? Why is it so difficult to teach? Because it does seem like, I would still say, like, everything I need to tell you about trading, I really could fit here on a cocktail napkin. And, but if that's true, obviously we should be able to have a 20-minute conversation about trading and you go trade successfully. And we know it's not the way it works. It turns out that in pretty much all cases, it's a journey of years. So why? Well, I don't think you can boil it down to one simple answer, but all of the related answers, I think, center around the degree of randomness in the market. And the fact that as humans, that's not something that we are naturally, maybe it's that we have not evolved to calculate randomness correctly. Maybe there was no benefit for having those skills, but for whatever reason, we don't tend to process random events very well, and we tend to make a lot of mistakes centered around randomness. And I think that's kind of the core It's not a very satisfying answer, but if you say, why is trading so difficult? Give me a one-word answer. Randomness is the answer.
Okay, easy, one word.
Yeah,
now
there
let's
you go.
now,
Done.
now let's dig into that more.
Yeah,
Because obviously one word isn't a big enough answer. But
correct.
what I heard from, or one thing that just jumped out to me in your explanation there is that people come from other fields that aren't trading, and they may
Yeah,
be experts in that field, and they've learned over the years, how to improve.
right.
How does that different to what the market environment and experience is giving traders in relation to feedback? Is that all because of randomness, or what's happening there?
Yeah, that's a very wise question, I think. Um, One of the groups of people who I have seen struggle most consistently, and this is extremely counterintuitive, engineers have a difficult time finding trading success. And it seems like they would be very well equipped for trading
Mm,
success. I think, let me back this out to another level. Another field where I have some expertise and experience is as a classical musician, as a composer and a pianist. And if you want me to teach you to play the piano, there is there's some element of natural ability. There's how your muscles are built. There's how your nerves are built. There's the shape of your hand. But beyond that, most people can do it. And we could, the cost is rather severe, but if you tell me you want to play at a virtuoso level, and I could map out, well, in 10 years, if you can spend 8 hours a day, most days, we can probably get there. And what we would do is you would do very precise things on the keyboard. And when you did not get the result you want, here's the key. When you did not get the result you want, we would modify what you do.
mm,
And it turns out that, for somebody learning to play the piano, it's a very powerful feedback machine that, the timing of because when you play, for instance, when you play a chord on the piano, the way you make one note louder than the other is that key has to go down faster.
mm,
But you want all of the notes to sound at the same time. So there's all of this very complicated processing that the human learns to do, but the ear is very precise. And if we're off by just a tiny, hundredth of a second, you can hear it and we can correct
mm,
that. So this is where it falls apart in the market. You can see that when you're learning to play the piano, you get immediate and very consistent feedback. What works for you on Monday is going to work for you on Tuesday and Wednesday. And that way you can shape your progress. Now, the problem is in the market, there is let's say a core of underlying truth. If you are, for instance, let's just take a concrete example. If you're trading equities over a certain time frame, and if mean reversion dominates on that time frame, you will, on balance, make a little bit of money. If you buy things that go down a lot and you short things that go up a lot, that will, with proper risk controls, at the end of a large set of trades, you'll have more money than you lost, probably. But what happens, of course, is that edge is very, very small, and the market goes through regimes where you might do that correct thing. You might execute the mean reversion trade, but you might get punished for it. You might lose money very consistently for days or weeks in a row. So the market's what we call technically a wicked learning environment. And what this means is that's from the psychological literature, that's actually a term, and
wow. Okay.
it's a term that feels right. If those of us who've traded for any length of time, yeah, okay, you get it. And what it means is not that there's no edge in the market, but the edge you have is small, and your outcomes are rather loosely connected to your actions.
Mm,
So that makes it, one thing. Do you remember? You might have seen this several years ago. Deliberate practice was all the rage in trading education. It was all people were talking about, and people were using models. What I just described at the piano is an example of deliberate practice, and there are many examples from athletics. Tennis is a very structured way, and so people were saying, can we adapt these deliberate practice models to trading? Because it seems like, yeah, it makes sense, right? We know how to build world-class tennis players, chess players, musicians. Let's just do this for traders. Have you noticed people aren't talking about that anymore? And the reason is that deliberate practice largely fails in trading because the learning environment is a wicked environment. It is not the type of environment where you get the kind of feedback, the kind of consistency you need to apply deliberate practice.
Okay, so I guess then the practical implication of that is that you could, for example, be doing the correct thing in the market, but you're getting feedback saying that it's not working, or vice versa.
Absolutely,
you're doing something that maybe you shouldn't be doing in the market, and it's working. So you're either learning the wrong thing or you're missing out on doing the correct thing, which is the challenge.
And it's even more dangerous for a beginning trader. And let's talk about what's happening right now. You go buy some stupid fake cryptocurrency, and I don't think cryptocurrencies are fake, by the way. That's not what I'm saying. But let's face it, there are. I'll try to avoid using 4-letter words here, even though my language is usually very colorful. There are some garbage coins. Let's say that, and you go buy one of these, and it goes up like 80,000%, and think about the learning experience you just had. Maybe you got a stimulus check from the US government and you put it in some stupid coin and you just made $500,000. There's somebody out there that happened to. Now, that person, look at this from that person's perspective. They made that money. That is a real trade. That is a powerful learning experience. That person will probably never be able to, if they wanted to, will probably never be able to actually learn to trade because they've had that powerful learning experience of doing something very stupid that ended up having a very good outcome. And this is something I've seen over my career at several different points. I saw people, if you go back to 2000, the .com explosion, so many people made so much money. Literally, I knew a preschool teacher who quit her job, opened a $2,000 trading account, and in a matter of a few weeks had close to $300,000. It was real money. She really made the money. And of course, what happened, you were in a very unusual market environment. And when the market environment becomes normal, there's no way somebody who's had that experience can adapt. So the fact is, you don't need any skill. I'm going to say something that's going to seem very strange in context of what we both do. You don't need any skill or knowledge to make a lot of money in the market. You need a little bit of luck. And but of course, what is you do need skill and knowledge and all kinds of discipline to make money consistently and to hold on to the money you make. If somebody has one of those lucky experiences and they never make a trade again in their entire life, that would be an okay outcome. But of course, if they continue to trade, they'll bleed that money. And this isn't just a story. I've heard this story over and over again. People making millions and losing millions of dollars and not being able to develop the proper discipline because of the horrific learning experiences they've had from the market. It's a challenge.
Yeah, you hear that quite a lot. Traders have beginner's luck, and and then they blow up or they lose all their money. In fact, I've had quite a few guests on the show that started out like that, and that's been the catalyst for them to learn more. Other people, they kind of just quit. But I guess the idea behind systematic and algorithmic trading is that that you're trying to determine what is the right thing to do rather than doing it from actual experience trading and looking at the results. Is that a solution to this problem, or is it deeper than that?
It's a solution, and there are several solutions. My argument is, as somebody who has done a good deal of both algorithmic and discretionary trading, I don't think these things are as different as most people think. And I realize that on from some perspective, they appear to be totally different because you have the very logical, very structured algorithmic trader who's going to do some research and then is going to follow a precise set of rules. And on the other hand, you have a discretionary trader who maybe looks at some made up lines on the chart and just does whatever he feels like any day in the market. In reality, I mean, there are people who probably fit both of the stereotypes, but neither one of those is really true. A good discretionary trader has done the research, maybe, if not explicitly, then they've seen enough market data that they've been able to tease out a lot of these behavioral elements. And there are things I think that we can process intuitively, or maybe not intuitively is the wrong word, wipe that, let's say inductive. There are things that our brains can do in terms of analysis and pattern recognition that you can't do with statistics. On the other hand, if you don't ever do stats, you're missing that. So I think both perspectives, most systematic traders I know would benefit from opening themselves to a little bit of those inductive insights. Most discretionary traders could benefit from the structure of a more rigorously researched systematic approach. But systematic approaches, you're still making a lot of decisions, right? Because what data are you testing? What time frame? What do you consider acceptable in terms of magnitude of edge, drawdown? What kind of leverage can you apply? What assumptions are you making, about your test, your Monte Carlo that's going to carry forward to the future? Serial dependence of trade. How much does this sort of matter? And you're still making some decisions. I would say, in my experience, I don't think the success rate for systematic traders is massively higher than discretionary traders.
Okay.
If a discretionary trader approaches it correctly, I would say.
Yeah, sure. Now, I just want to dig into randomness a little bit more. You've explained why it matters and the impacts it can have on traders, but there's this random walk theory. People subscribe to it, people don't. Is it really an academic question, or is it just academic randomness?
No, I don't think so. So this is one of the things I get a lot of pushback on, and usually, frankly, from people without the mathematical background to really understand what we're talking about. People will say, I would say one of the things that I believe to be true about markets is that most of the time markets move randomly. And the problem with that statement, and the problem with defending that statement is you probably know, you can't prove something is random. What all of the tests for randomness do is look for evidence that it's not random. So, you can only say something is random within the bounds of probability it's likely to be random. But, still, I would say my experience, both as an actual trader, having done tens of thousands of trades and doing a boatload of research, is I think most of the time, most markets move randomly. Now, somebody will say, wait, that can't possibly be true because people don't trade for random reasons. And that's, while I understand the logic there, what that person is missing, and sometimes you can talk them around to understanding this, is even if you have people, the way I think about it is if you throw a piece of fish food in a pond, and then if you were to graph the movement of that piece of fish food, I would be willing to bet it would look something a lot like Brownian motion, look a lot like a random walk, even though each fish bumping into the food has an intent. It's not just randomly bumping the food around. Each fish is trying to take a bite. The sum of all of these vectors playing into the thing, move the thing randomly. And I think that's what happens with price. We have most people don't understand all of the complex reasons that people make buying and selling decisions. Discretionary traders are particularly bad about this. They will learn some stupid system with some indicator and a moving average, and then they'll think that everybody in the market is looking at the same thing. And Warren Buffett is not looking at your 5 and 18 period moving average cross and deciding when to buy or sell something. There are so many reasons to say nothing of trades that are derivative of something else. Somebody does a big trade here, then they hedge part of it here. So there are enough of these things that play into it that most of the time price moves randomly. Now, I think that is that is something that academic research is pretty clear on, and it's something that has a practical application too, because if you understand that, what that's going to make you realize is that your job as a trader, whether discretionary or systematic, is to find those points when the market might be a little bit more predictable.
Mm.
And you can think a lot of good entries happen when the rubber band is stretched in one way or another. And maybe that could be a market has moved to the upside or downside. Maybe it could be exactly the opposite, and volatility is very compressed. But when something has moved to the outside of normal bounds, that's where we start to see things potentially get a little bit less random. And if somebody approaches the market with that understanding, it sets an expectation that's very different. Imagine what would be the polar opposite of that. Maybe somebody who comes from one of the, I call them like mystical woo-woo systems like GAN or something, where somebody would believe that every tick of the market is predictable. And if you're not predicting it, then then you, the trader, are responsible. And no, the reality is usually the market is unpredictable. So it helps you, that's a little psychological crutch right away that also happens to be aligned with the reality of the market. It's nice when those things work like that. And it's also, one of the not very interesting reasons, but one of the reasons that trading is hard is because real edges in the market are very small. Right. It's the equivalent of, let's say you and I are going to play a game flipping a coin, and the coin is not fair. Well, the coin might come up heads 52% of the time. Like, that's a legitimate market edge, maybe a really good one 55% of the time. What does that mean? It means I'm going to lose a lot, even if I'm on the right side of that coin. And the coin is not going to come up 90% of the time heads. That's just not the way it works. And if it did work like that, then the markets would cease to exist. Markets are extremely competitive. That's another aspect of this.
Yeah.
I feel like I rambled a lot. Does that address that? Or
no, it does. And I want to ask you about the times when markets are less random. What are your thoughts about randomness across timeframes? And by that I mean, if you look at a 1 minute chart, visually, it might look more random than a 1 week chart. So, do you think there's different levels of random across timeframes like that?
So the academic answer is that, interestingly enough, all of the studies that will show you that prices random walk are based on longer time frames. So they looked at which contradicts what you said, and also, by the way, contradicts my intuition too. And I have traded a 1 minute chart fairly actively, so I know what that looks like and feels like. And my sense would be that there's a lot more garbage on that 1 minute chart than there is on the weekly chart. But if you actually look and see, let's say it like this more correctly, you will see violations of random walk more commonly on lower time frames. So, this also you can see the truth of this, because if you have a market that makes a big move on, say, a economic report or a Fed report or something like that, you will tend to have some more predictable oscillations coming out of that move. So I think the academic answer is clear. Higher time frames tend to look more random when you analyze them statistically. From a practical trader's perspective, there's a lot of garbage on a 1 minute chart. But if you really pick your spots on those lower time frames and you find those points where the market is likely to be less random, and that's where you choose to engage with the market, which I guess is still kind of academic language, but I have no business putting risk on in a market if a market's just bouncing around randomly. That's a great way for me at best to pay transaction costs and maybe make a mistake. I have no real expectation of winning, but if I wait for those points where the coin's loaded a little bit in my favor, then I can play the game.
Yeah. Okay. Thanks, Adam. So we've got a couple of questions here in the chat that are kind of appropriate with what we're talking about now. So let's I put them up on the screen. This first one is from Good Old Boy the Man. Hey, Good Old Boy. Okay, Goodo. As a discretionary trader, how do I prove I actually have an edge and can be consistent? Consistent, profitable for years to come.
This is the question that for many, many years kept me awake at night. This is the question. So as a discretionary trader, there are so many pieces that play into your execution. And this is one way that systematic trading is certainly cleaner. I would say the only way you have any expectation of having an enduring edge would be if you have evidence that has worked historically, so you've done some kind of back test, and my confidence in back test is right around zero. If I did it, it's right around zero. If somebody else did it, it's less than zero. But a back test is certainly no proof, but then you need forward test or real money results that are consistent with the back test. And if you have a back test that that shows over a large period of time the tendency you're trading is stable, and you have real money results that verifies that your actual executions look something like your back test. And I'm being soft with that, but we can look at that in a lot of quantitative ways. So you just want to see that you're able to execute something that looks like your back test. That gives you some degree of confidence. But what I also will tell you as a discretionary trader, and this is something that I've become more aware of in recent years, systematic traders are well aware that systems come and go, and that even a good system might need some refitting, or you need to adjust some parameters, something like that. I would tell you as a discretionary trader, I trade daily charts like I traded 3-minute currency charts in 1997. Like I trade the same way. But I also know that's not true, because what has happened is, and I see this from my trade records, I make adjustments in stop placement, in exit methodology. So I think that a discretionary trader, if you have the clarity you're not being too influenced by emotional decisions, and you're doing the statistical analysis to truly understand your results, your approach will wander, will evolve, will adapt to the market in some ways a little bit more naturally than a systematic trader who might need to have something, have a control chart, go out of the norm and say, okay, well, we need to take a look at this system. Every trading approach has drawdowns, significant periods of drawdowns. There is no enduring. We all have the fantasy that you're going to find some way to trade where I don't know if I'm reversed, but I'm hoping I'm going from the lower left to the upper right, where your equity curve is just a straight line and you just make a lot of money. But the reality is it doesn't work like that. Every trading approach has significant drawdowns. And I think some of those drawdowns you experience as a discretionary trader are where you're going through these periods of slightly refitting. So, I know that's not, I think that's the real answer. And it's not a sexy answer. It's not an easy answer because it is hard work. One of the other things you'll need to know as a discretionary trader is that you are a key part of the decision process. And if anything ever happens to compromise you, illness in the family, divorce, real estate problems, lawsuit, those kinds of things that are like these a new birth, they don't have to be bad things, they can be good things, a new addition to the family. Anything that sort of blows up your world is probably going to have a negative influence on your trading. So what you would be wise to do is, when those things happen, scale back your trading experience. And I have seen people, traders that make millions and millions of dollars a year say that this is not going to happen to me, and it does happen to them. It happens to everybody, and you're no different than anybody else in that regard.
Yeah. Okay, we've got some more comments and questions here that I think we'll save to the end so we can move on a little bit. So when we had a discussion a couple of days ago, and we were talking about what we were going to discuss today. And you said a very interesting comment, which I want to ask you more about. and that was psychological problems can be fixed by behavior. Um, now, I think people probably recognize that psychological or trading psychology is a big part of trading. And obviously, we're talking about why trading can be so challenging. So it seems like a nice fit. Can you explain what you mean by that comment? Psychological problems can be fixed by behavior.
Let's add a qualifier there and say sometimes, or because not all problems can. So this is a topic that I've been focusing on a lot over the past year, and I'm writing a book that I'm very excited about, that I think will be I hope will be an important addition to the literature on trading psychology. And it's a complex topic. One of the things, actually, let's circle back to randomness. One of the things that will be in the book is we came up with this protocol, and this has been very interesting. We put a few traders through it, but we haven't released any of it publicly. My belief is that this, as we said earlier, this random nature of markets and the degree of randomness in markets is what makes trading so hard, and people don't process randomness well. So what we have done is have created a set of exercises where somebody is forced to face randomness in a very experiential way. So this is not it's not sitting down in a classroom and looking at a probability space. It's going through, at first, things that have no actual risk associated with them. So you're looking at things with cards and coins and looking at outcomes and looking at runs, which of course could be a string of runs, could be winning trades or losing trades. And then we do the same thing. We move into the market to actually executing very, very tiny trades on completely random trades and looking at the outcome with different placements of stops and targets, different ratios. And what we have found is that people going through this and people experiencing that, by the part of the answer to many psychological problems is just having many exposures, many times putting a trade on. My first trades I did, I like to tell the story. I won't tell it in detail here, but I thought I was very cool because as a musician, I never got stage fright. I had to make myself have stage fright so I would play better. And I thought, I read books about people talking about, trading is emotional. That won't be me. And I put on my first trade and I was impressively emotional. I had stress reactions, physical stress reactions, breathing, heart rate, skin turned red, things I didn't even know my body could do. And so, everybody has these. Part of the answer is unfortunately experience, how do you, experience is the answer. How do you get experience making bad decisions, right? But once you've done hundreds of trades, you start to care a little bit less, and that's actually a good thing. But what this protocol has also been able to do, because somebody is, you're putting on many, many trades, which are actual trades. They don't have much risk, but so you get many different exposures to seeing risk in different ways in the market. And the interesting thing with that is that once somebody, you can read all you want. We could spend days talking about this, but it's very different once you start to experience randomness. And then, the last part of the protocol is we let you make some decisions. And a very interesting thing happens if you are given these sets of trades and you're allowed to make decisions. In most cases, your results will be worse than random. You would be better off just letting it work out randomly. But once somebody has fully embraced this random outcome and the random movement of the market, their decisions tend to actually be surprisingly good, better than what you would expect randomly. So I think what we've done here is something that I don't know that anybody has done in such a structured way, which is to nail down that part of the psychological issue is just not really understanding what it feels like to interact with randomness. I would also say, though, that a lot of things that people think are psychological problems, for instance, let's say you came to me and said, "Hey, Adam, I found this great system. I'm going to trade these Fibonacci retracements and Elliott waves and phases of the moon. Somebody keeps sending me this hilarious research report on financial astrology, and said this is how I'm going to manage all my money, but I have some psychological problems. Well, think about it. I picked an obviously I can't even speak. Absurd example. That person should have psychological problems, right? Or to take it into a little bit more of a realistic setting, a trader who does not have an edge, who is struggling and losing, that trader should have psychological problems, right? Because you're doing something that doesn't work. You should not feel good about it. So a lot of things that we think are psychological problems in trading that people want to address. And I think this is one of the great dangers with the people who say trading is all psychology. Well, I would say that's absolutely untrue. But if we address your psychological problems before we address the aspect of you actually having a reason you should be trading, having an edge, then we do a disservice. And there are so many times that people are struggling with things, and the answer is actually to modify the behavior, and the psychology falls into place, which I know seems backwards. But and look, I'm not trivializing it. I've experienced in myself making completely irrational decisions. I've done things I've known in trading have been very self-destructive. I've blown up accounts through single stupid revenge trades. I trained a trader one time who I saw, we were in the same place, and he was physically unable to make his finger move to click the mouse button. Wow. So that was the stress. He actually had to use his other hand and mash his finger down on the mouse. So I'm not saying that all of this psychology stuff just goes away if you do the right thing. It's not that simple. But the first thing I think we need to make sure is that you have a reason to have an expectation to win in the market. And if you don't, then frankly, you should have psychological problems about your trading.
Yeah. Yeah. So do you think then there's a bit of a gap in the understanding or the application of trading psychology? Because, there's a lot of books out there and a lot of research studies and technical papers on, the impact of trading psychology. And do you think there's a gap somewhere along the way, or people unable to apply it? Like what?
Yeah, I think I understand the question you're asking, and it's a hard question it's a hard question even to ask, right? Excuse me. I think there's a gap, and look, to be sure, people have problems making decisions under stress. We don't trading is such a strange thing in the human endeavor, if you think about it, because you never have all the information. You never have enough information. When the time comes to act, even if you're a systematic trader, you still push the button. When the time comes to act, you have to act right now. You have to make your decision right now. And there is risk involved. There's fairly significant risk involved. And that's not normal. That's not how anybody who's going to make a major life decision, you're going to get all the relevant information. You're going to spend time ruminating on it, and you're going to think of all these different ways to structure the decisions. And trading is definitely not like that, and it carries huge consequences. And furthermore, there are some of these. I think people have talked about this enough that we don't have to talk about cognitive biases. People will misattribute things, will put too much weight on some things, will ignore certain kinds of risks. I think there are a lot of lessons from this coronavirus pandemic where the public has misestimated risk. They're just trading also cues in on a lot of these things that we don't do very well as humans. So there certainly is a place for thinking about that. There certainly is a place for thinking about how your cognitive machinery works, and for tuning it up, and for trying to make the best decisions you can. But I think where a lot of the trading psychology stuff goes wrong is, as I said, it trivializes the fact that you absolutely have to have an edge in the market. And one of the things that people say, you don't trade the market, you trade your beliefs about the market. That's a very common thing you'll hear
Yeah.
people in the trading psychology community say. And look, I suppose that's true. I suppose that I'm not, by the way, completely opposed to. This is not the conversation we're having, but I'm willing to leave the door open for other avenues of experience and knowing, and for some things that would verge on, people would say, mystical, different kinds of experience. I think those things are real in the human experience, so I am not trivializing that, but I do think we also need to acknowledge there are underlying realities in the market that you are bound by. And when you tell me that you don't trade the market, you trade your beliefs about the market, that is a very small step to, you can do anything, you can win doing anything you want in the market. You just have to believe in it. Can you imagine if your airplane pilot approached flying like that? Don't worry about it. Just go with your, or obviously it's absurd. And so the people who focus on trading psychology, I think, really soften this aspect of how hard markets can be. And I mean hard in the statistical sense. There are mathematical realities. If you're betting 20% of your account per trade because that's what your belief system says, let's talk in 6 months and you can let me know how your trading experience was. I think we know what the outcome will be. So I think that's one of the most significant disconnects I see.
Yeah. Thanks, Adam. I just want to ask you one more question before we get into some of the questions in the chat. There's a lot of comments going through there. And it's something you just touched upon, actually, is you mentioned the coronavirus, a pandemic. And if you think about like the last couple of years, we've had a lot of uncertainty in the markets, not just from that, but we've had, political uncertainty with changing of presidents and parties and things. We've got the Fed pumping trillions of dollars into the markets. We've got people getting their welfare checks and trading the markets because they've got nothing to do. There's so much going on now, and in the last couple of years that I think you mentioned mispricing risk and things like that. So what can traders do to, I guess, kind of adapt to all this uncertainty happening at the moment?
Yeah, to me, I think the most concrete example, and well, actually, a good example here is we just had yesterday the reentry of the Chinese Long March rocket, right? And there were people who were very concerned about getting hit with a 22 metric ton piece of space debris moving at terminal velocity, which obviously, if that happened, would be a bad outcome. But and this is exactly the kind of thing where the probability of something happening is very, very small, and the consequence is very serious. We will tend to, with very reliable, we'll tend to make very, very, very reliably, we'll be wrong in how we under or overestimate those risks. And so I think that is one thing where, personally, knowing where I'm most likely to fail and where my intuition is likely to be least reliable is very valuable information. And I know on these, for instance, the scenario of hyperinflation and monetary collapse in the U.S. is a horrifically bleak scenario. We could definitely trace out some paths that would get us there, but it's extremely unlikely also from a probabilistic standpoint. People would disagree with that. So just thinking like that, knowing where my internal calculus is likely to misfire, and trying to, this is why my approach, one other thing that I think is interesting about my work, I won't say unique, but I do a lot of fundamental work. I do deep time series analysis on basically every major economic number. So right away, what that will tell you is when you start to see the variability in some economic numbers, there's no point to talking about little jiggles in a jobs report, even though every journalist in the world is frothing at the mouth to talk about it. that's like 1 sigma deviation. It's not even worth talking about. So doing some hard work on macro numbers is very helpful, but also my trading decisions are very close to 100% dictated by, I would say, price action, by what happens in the market. And that has been, our institutional advisory, we've been on the right side of the market. I won't say we've been right at every turn. Nobody's right at every turn, but we've been right for a decade here. And I think we've raised concerns for, and these are for slower moving allocators. We've raised concerns at the right point, but not very often. But usually our message has been, it's a bull market, stick with the uptrend. And there's no genius in that call. It's very simply dictated by what the market's doing, by what's happening with price action. So I find that knowing how markets tend to move, and here's an aspect of market movement that is not random. Understanding trend structure, which we could look at from a discretionary or systematic standpoint, understanding the kinds of things that. So okay, my thesis is, this is a bull market. I want to stay focused on being long stocks. I want to pick my spots where I buy things that are not overextended. So that's my operating worldview. But I also, again, knowing my cognitive biases, knowing what biases, knowing where I will make mistakes, I spend a lot of time focusing on scenarios that would contradict that. If this happens, that would prove that the uptrend's not as healthy as I thought, basically. And until I see those things, have I covered every possible scenario? Probably not. Maybe I'm missing something, but they all tie into some common aspects of price action. Until I until I see that, I'm going to stay very focused on being a bull in stocks in a bull market, and that's a pretty happy place to be, actually. And I'm okay with that.
Yep. Okay, well, let's head to the chat now. We've got a couple of questions here. So let's start with Jeff J. G'day, Jeff. Thanks for the question. Jeff would like to know, what discretionary items do you use in your trading, and can you give a trading edge with it?
A lot of the things that we look at from a discretionary standpoint focus on trend continuation. I would say pullbacks, but various kinds of pauses and continuations in trends. And there are ways you can quantify these things. But what you can't do, what I have not been able to do, is to find a quantification of that works as well as a discretionary approach to it. So I can give you the pieces. I can show you how to trade it from a discretionary standpoint. I can tease out a back test that will show you an edge, but it's a smaller edge than you will realize trading it as a discretionary trader. We don't do much with discretionary trading in terms of mean reversion. In my experience, for better or worse, I think that is an approach that needs a more systematic approach, because what you're doing when you're trading mean reversion is you're doing things that for a discretionary trader are pretty counterintuitive. And if that's an aspect where I want to, in one of our earlier calls, I said, you get to suffer as either a discretionary trader or systematic trader. You get to pick where you suffer. And I would rather suffer in mean reversion doing the work on systematic development instead of having to see these trades come up and say, I'm going to take that one and not take that one because I know my decision making is going to be very bad. There again, you see the same thing. I've spent a lot of time as a discretionary trader understanding where I'm likely to be weak and where I'm likely to make mistakes. And then I just won't play that game where I'm more likely to make mistakes.
Okay. Thanks, Adam. Here's another question from Goodo Boy the Man. This is a two-parter, so I'll read it. I researched both algorithmic and discretionary trading approaches. As a discretionary trader for 4 years staring at price and patterns, can it be that my skill set, confidence, and ability to trade, second part here, so can it be that my skill set, confidence, and ability to trade, subjective or discretionary, is my edge, rather than trying to program and backtest it with a algorithmic system?
Yeah, we've talked so much about about discretionary trading here, but I'm really a numbers nerd. Like I really uh, like to try to analyze and quantify everything possible. And like, what I just said in that previous answer, I've had to come to accept that there are some things that just can't be quantified. And I would say if you are, if you have the real money results showing that you have an edge, I think you'd be a little bit crazy not to trust it. What I would encourage you to do, I assume in your systematic approach, you understand there are ways to look at your system performance and to say, control charts we borrow from manufacturing, things like that, that you see your performance has gone outside of the normal bands for your methodology. I think you need to analyze your discretionary trading in the same way, because what you do need to be in tune to or looking for is some evidence that your edge might be weakening or that it might not be as strong as you think. But I would say I don't know the details, but I guess I'm kind of making some assumptions and reading between the lines of what you've written here. If you have done some back tests, if you have some actual trading results that look good, then what are you waiting for? Trade it. Trade it and increase your size, monitor your performance. If something goes wrong, then then you can look at that. But if you're asking a question like that, you probably have some results behind it, I would assume, that would justify putting some risk in the market. So do it.
Mm-hmm. There's a similar, well, actually not a similar question, but this question here from M Squared Trader. You just answered the first part, but how do you decide when to stop trading your discretionary system or that it needs adjustment, which is a slightly different way, I guess, to look at it. So,
yeah, it's a slightly different way. For me, knowing that it needs adjustment is a little bit more of an, I hesitate to use this word, but I think it's valid. It's a little bit more of an intuitive sense. It's the sense that you might not even see it in your actual trading results, but it just doesn't look right. It doesn't feel right. Or you have that nagging voice in the back of your head that says this could be better. You need to look at this. Certainly, if you start to see that that your performance is suffering, that tells you something needs adjustment. But one of the things that I've seen over the years is you'll have this idea, what if we did this? What if we looked at this? Just a concrete example. What if we, instead of doing a trailing stop, what if we took all of the profit at a profit target? That's a pretty elementary example, but then what is possible to do is go back and look at your recent trading performance and do some pro forma analysis. So now you're into back tests. And what did I tell you about back tests? I don't trust it, but it's kind of a hybrid backtest thing, right? Because those were actual trades that now we're saying, what if I had done this? So I still don't trust it much, but if you see that those numbers look good, what probably happened was you had some implicit pattern processing that said you need to look at this, and then you can look at carrying it forward. The other way it happens is you'll see some degradation in your performance, and you might need to tweak some things there. And some approaches, it might be possible that you're trading something that just simply stops working. But there are, for instance, maybe you're trading a system that looks at when different ETFs rebalance, and you're looking to take various trades around that. Well, if the way the ETF is managed changes, your edge is going to go away. So there are things like that you can draw some direct causal links, but for something that's more, let's say generically price action oriented, I think that those other two answers are probably the right answer.
Yep. Thanks, Adam. A question here from Horo. Welcome, Horo. Instead of holding out of sample data for the same ticker as a test, thus losing some data from the development phase, can I instead use a different ticker in its entirety as my out of sample test?
No. No. And why? So, again, that's a smart question because most people don't understand how out of sample works and how hard it is to do right. The reason you can't do that obviously is because tickers are highly correlated, so it's not a true out of sample. I would say, from a practical perspective, because technically once you touch that out of sample data, you burn it, right? And technically you have one shot at an out of sample test. And I think depending on your frequency of trading, I would be willing to substitute a walk forward for out of sample. In most cases, I think that's a more practical standpoint, or more practical perspective. The other problem with out of sample, of course, is market regime. What if let's just say that you were doing your system development and your data set ended in DECE 2020, and let's say you decided to hold your out of sample would be March through DECE 2020. That's going to be a weird out of sample, right? So that's obviously a very extreme example, but there are definitely issues with out of sample. And I would feel better about a forward test either on a simulator or depending on your risk tolerance, even with real money, small executions. That's always best, I think.
Yep. Okay. Next question is from YSSJC. Welcome, YS. Why is Forex so hard compared to stocks?
Well, is it? I think it depends how you trade. What I have found over the years is that swing trading currencies and stocks is not really that much different, even though from a quantitative perspective, they behave quite differently. I think the reasons that currencies in general are probably harder to trade is that they tend to be more random most of the time. I love all of these Forex YouTube channels explaining how the big banks trade with moving average. That's not how currency markets trade. If you understand the volume of these transactions and how even moving a little bit of money, a relatively little bit of money around, how many different transactions it might take, how many different ways the markets might move. There are just a lot of derivative, and I don't mean derivative in options or futures. I mean, a transaction that is caused by or derived by, there's probably better language for that, another transaction. So there's a lot of random action in currencies. There's a lot more noise in a different way. Stocks are in some ways more predictable. Stocks have been, stocks certainly you have what old traders would have called a primary trend, but one of the challenges of stocks is also that correlation to the index, that if you put on 20 stock positions, you don't really have 20 independent risks, do you? You have more like one, and that's certainly a problem. So I think they're very, very different, but I have seen over the years with pretty remarkable consistency that currency trading and stock trading, if you can trade them as programs, they do somewhat tend to offset the drawdowns from each other. And this is not to say, again, I am not saying that you can have a P&L line that's a straight line, but what you can do is when one of those systems is really suffering, one of those asset classes is suffering, you'll make enough from the other one to at least make a little bit of money or maybe break even. And that's not a bad place to be.
Yep.
Short answer is they behave significantly differently.
Okay. Thanks, Adam. Here's a question from Dalibor, I think is the pronunciation. This is a good one. What about hybrid systems? That is a combination of algo and discretionary. What do you think about those, Adam?
Love them. Absolutely love them. And there's a lot of different ways this can work. I think one of the probably not explored enough approaches is what we would call a gray box, where maybe you get your entry from an algorithm and then you're responsible for a discretionary exit. I think this is something, of course, what you do with these systems is development becomes problematic because your degrees of freedom just kind of explode. And if you're trying to do any kind of legitimate back test, you have to realize your degrees of freedom probably approach infinity. So your back test is not going to be very reliable. But if you if you can tease out an edge, this can be a very, very good way to trade. I've known lots of traders. It's not something a lot of people talk about, but I've known lots of traders on both the individual and discretionary side that trade like this. So it's absolutely worth exploring.
Yeah. Okay. Thanks, Adam. Here's another question from Jeff. How do you decide which markets to trade? And do you consider news in your trading?
I don't consider news in my trading because by the time it's news, it's already happened. There might be times that I might make a trade that line up with news, but what I'm really trading is the market movement. So I don't need to know the news. And this was really driven home to me very clearly more than a decade ago. Everybody gets in this mindset. What's the news? What's the news? What's the news? I have to know the news. And people get squawk boxes and newsfeed, Bloomberg. And I was sitting at a trading desk with a friend, and we both had a position on. And I said, "What's the news? What's the news? What's the news?" And I think he was horrifically hungover. So he just couldn't be bothered that day. And he said, "You know what? What's it matter? Why do we care?" He said, "What are you going to do if your stop gets hit?" Because I'm going to, okay, I see the wisdom of your approach. I'm going to get out of the trade. And I think more people, the idea, I guess I know a little bit about algorithmic approaches to news reading. And I know that by the time my big wet brain can read news, process it, think about it, I know that lexical algorithms have already ripped it apart and made trading decisions, and those trades are done. Yep. the war is over. The tanks and airplanes have cratered the battlefield before I even show up with my club. It's completely the wrong. It's completely the wrong weapon, completely the wrong speed, completely the wrong scale. It's the wrong game to play. So maybe people have different approaches, but I'm very skeptical that anybody can actually make trading decisions off of news. I will make decisions off of things that move because of news, and there are things like earnings drift. It's probably a phrase that means something to you if you are familiar with the literature. There are some signals that are associated with news, but I would never know. The only time that I might really want to know the news is if I'm looking at trading a ticker and I see a move in the market that might be some corporate action, a buyout or something, and I want to know, if there's a pending offer for that stock at $46, I'd probably be an idiot to buy it at 45.5, right? That's not a smart trade to make. And to answer the first part of your question, I screen stocks for liquidity and movement first, and then I put them through. I have a bunch of screens that I use that give me trading candidates, and then I make discretionary decisions based on the products of those scans.
Okay. Thanks, Adam. Now, I realize we've just gone over our time, so can you hang around for one or two more questions before we wrap up?
I'm fine. I have a lot more time, as much as you want.
Okay, thank you. So here's a follow-up question from M Squared, who asked you before about how to know when your strategy needs to be adjusted. So thanks, first of all. How far back do you typically back test and forward test your discretionary systems before you go live?
Now, I'm a nutcase. I would say the core of my trading approach, as I said, is trading, let's just say, pullbacks and trends. You're looking for an established trend, and you're looking for some kind of pause. And there are a lot of ways that we could measure that. And I have found these patterns. Now, again, the problem is, as I said, the actual quantitative edge is very narrow. It's there, but it's not something in a purely systematic approach that I would be comfortable putting risk behind. But it's enough of a verification of the tendency. I have tested that over the complete history of equities in the US. and found that tendency to be stable. And then I thought, well, what if, so let's, and of course the problem is when you go back further, the data gets extremely sketchy. We do have price records from the Middle Ages, and the thing that really frankly shocked me was when we started looking at barley prices in Europe in the 1300s. You find that these same types of markets move in the same way, and you can't, the price data is, as you imagine, there are a lot of missing data points, but I believe that I could trade my approach to stocks today in commodities in Europe in the Middle Ages. And it's even crazier. Those some of those early first clay tablets we have are price records from Mesopotamia 6,000 years ago, and they're price records. Now the way merchants recorded prices was they sort of did point and figure charts. So nobody wrote down a price every day, but when a price changed a lot, they would note the price change and the date. So we have been able, with big glaring holes, to reproduce price records legitimately from antiquity, and some of the stuff through the Roman Empire with better records. And we do see these same elements. Now, I'm not saying that these are actual back tests, but what it does point to is that there is some aspect of human psychology. Maybe it's in response to velocity of price change, maybe it's in response to risk, but there is something about this approach that is very enduring. Now, that's not really the answer. So, I told you I just tested things with 6,000-year-old data. From a practical standpoint, I'm going to want to see if I'm looking at a new approach. I'm going to look at it over the last 10 years and on the daily chart. And I'm also going to go back and I'm going to pick out some specific points. I'm going to look at the bear market in mid 2000s and in end of 2000s. I'm probably going to go back and look at the 1980s, even though it's a very different market. And I won't necessarily expect that a system that works today will work then, but I'm interested in how it fails. And I'm interested in what is not consistent. And but the practical answer for daily charts is probably 10 years. I think there is not, I used to say I would test things on 700 stocks, but of course, because of correlation, that's really, it's not that powerful of a test. You're getting a lot of coordinated answers, which are not very reliable. For intraday, and this is one of the things we're doing a lot more of right now, a lot more of this very disciplined system development. Even the past few years, I think, is enough. But my expectation is that if I do a back test on a daily time frame, I'm going to expect that thing to be relatively stable for many years. I would not necessarily have the same expectation for an intraday system.
Yeah.
So it's a different standard of proof.
Yep. All right. Thanks, Adam. It's good to know we don't need to back test on our clay tablets. So we can leave them all in the garage.
Necessary, but interesting.
All right, one more question, and then we'll wrap up for today. So this one's from Tirth. Tirth has posted a couple of questions, so we'll just pick the most recent one from Tirth. G'day, Tirth. Thank you, Adam. How do you screen for stocks pulling back in an uptrend?
Well, it depends. That's, on one hand, it's kind of trivial, right? Because you could set a variable that would be the highest high of the last N days, and then you could look at the closing price and make sure that it's some fixed percent of that. And you could also look at momentum. You could look, when I say momentum, I mean that in the I can't believe I just said that. But one of my common rants is how imprecise technicians are with mathematical terms. But I guess what I mean is velocity in that sense, or you want to make sure that maybe there were no large shocks in that pullback, but you could simply look at your X percent or X average true range or something, or X sigma off of the highest high of the past whatever, 20, 60 days, whatever. That would be a good place to start. Now we have a lot more. What you would find with that is you're going to get a lot of charts that will work. You're going to get hundreds of charts, and a lot of them are going to be garbage. So then you're going to have to do the discretionary filtering. You can do. I go a little bit further and I bake some other things into the scan, but of course none of this is perfect. So when if you want to get those 200 stocks down to 40, those 40 are going to be higher quality setups, but you're also going to miss some potentially good setups. There's just no way to avoid that. But I think the basic way you could start with it is just you could also do some things. I don't use moving averages in a lot of applications, but one thing you could do is look at something that has been maybe like touched an upper Bollinger Band or something and is now touching a moving average. That could potentially give you some kind of pullback scan, but you would need to, again, you'd need to probably filter it for some downside momentum.
Yep, sure. Okay, thanks, Adam. Well, appreciate your time today. We've gone a little bit over, but you've been very gracious about that. So it's always a pleasure to talk to you. Now, if people want to get in touch with you or to follow you to learn more from you, how can they do that?
I think kind of at the risk of dropping like 8 websites here, just follow me on Twitter at Adam H. Grimes. I kind of use that as a central. I'm still trying to figure out how to use Twitter, but whenever I publish a blog post or a video or something, I put it out there. So you can follow me on Twitter at Adam H. Grimes. If you're interested in learning about discretionary trading, I have a fairly extensive and completely free trading course at marketlife.com. So you could also check me out there, but Twitter's a pretty good central hub.
Yeah, I actually saw a comment in the chat about that course. Let me just put it up on the screen so you can get a bit of love for that one from Cassius. Thanks, Adam. Best course I've done and free. I'm still struggling, but on the way to get there. Trade plan and discipline. So
fantastic. That's good. Yep. I put up. So I did this course like 10 years ago, and I did a complete revision. I don't know, maybe 3 years ago, and I saw so many what I thought of as abusive trading education systems, right? I had a friend who spent $20,000 literally to go sit in a classroom and learned absolutely nothing. Mm-hmm. And I thought, you know what? I'm just going to put a really good free trading course out there. And it's helped, it's actually found the most traction with professionals, with people either, because it is a almost academic course, but with people either coming off the floor, learning to trade on the screen, or with people transitioning out of hedge funds to trade at home. Those people have found some pretty useful things. And it's from listening to me today, my approach is mostly discretionary, but that course also is fairly mathematical. So I think it's something that somebody with a systematic focus, you would probably find 60 to 70% of the course probably speaks directly to system development. It's completely free. There's no hidden upsell or anything there, but marketlife.com.
Marketlife.com. Excellent. All right. Well, we're getting a lot of thanks in the chat. So how about I share a few on the screen just to wrap up for today? And let's go. So Good Old Boy said, thank you for answering your questions, answering Good Old Boy's questions. We got a thank you from Dalibor. Hopefully I got the name correctly. Jeff said, thank you for your answers. I appreciate it.
You're
M
welcome.
Squared said that was your edge. Sorry, I can't read right now. That your edge was wasn't that far back. Thank you for advice on the back testing. We got thanks from Ola. Many thanks, Adam and Andrew. G'day, Ola. RDE, thank you. Awesome laid back conversation. Oh my goodness, there's more and more coming through now. Kentucky Dan. G'day, Kentucky Dan. Thanks, Adam. Friday, Saturday. Like to say, great conversation. Thanks to both of you. There's more coming in now. I can't keep up. So.
You don't have to. Thank you. And look, I really I appreciate this opportunity, and everybody who just sat and listened to us rambling for an hour. I appreciate your time and focus, and it's really it's a privilege to be able to speak to people about something I love doing. So thank you.
Yeah, thank you. And thank you for everyone who attended today. And we got some great questions. I'm still posting things up on the screen, so it's going crazy here. But if you did enjoy today and everything that Adam has shared with us, please show your appreciation by hitting the thumbs up button on the video and leave a comment. Perhaps if you want to drop some of your takeaways from today, I read all the comments. I'm happy to engage in a discussion with you. And yeah, all the best, Adam. Thanks again. And
Thank you.
take care.
You too. All the best.
All right. Cheers. Thank you. Bye-bye.